Welcome back to my channel where I discuss the various economic topics that impact our real estate market and economy in general. Today, we'll be delving into a critical economic phenomenon called stagflation, which is a unique and challenging situation that can have significant effects on all different aspects of the economy, including the real estate. So let's dive in and explore what happens to the real estate market during stagflation. But first, I would like to remind you that if you're planning on relocating, whether that is across country or across town, let me assist you in finding a trusted realtor provided with a market analysis of the area of your choice. Just click on the link below to begin the process, and I will personally be in touch with you. Before we delve into the impact on the real estate market, let's quickly understand what stagflation is. Stagflation is an economic condition characterized by stagnant economic growth, high inflation, and high unemployment. We have seen all of these conditions taking place at this time. We are seeing high inflation. We're seeing high unemployment despite the numbers that were given. We know that unemployment is at least 5 times higher than the 3.5% rate that they're telling us. We're seeing the stagflation scare is soaring through the effect that is having on the banks and the bonds and the Bitcoin market. So they're saying that there's 54 out of 85 indicators just showing that stagflation is actually starting to happen. We can see on this article, it mentions all these indicators having to do with the US PMI, employment, and future expected output, the inflation, and the output price index. And the biggest 3-day decline in the US macro surprise index since May. And it says, interestingly, it appears the steepness of inflation signaled by these reports trumped the slowing growth, and short-term markets shifted significantly more hawkish, with expectations now for not cut from this week, 25 basis points hike through at least January 2024. Treasuries were sold across the board, with the short end underperforming. Bonds were bid during the early European sessions, but as soon as the US Open, selling began, which flattened the yield curve back towards the SVB lows. And the dollar was also very quiet, meaning that we have a weakening dollar, and Bitcoin tumbled back below $30,000. So these are just some indicators that stagflation might be here. And how is that going to affect the economy? How is that going to affect the real estate market? So let's take a look at what's going on as far as the real estate market is concerned. During stagflation, people's purchasing power takes a hit due to high inflation and unemployment. We know that unemployment numbers are at least 20% instead of the 3.5% they are telling us. So as a result, the demand for real estate decreases as affordability also decreases due to these higher costs. People are more cautious about making financial decisions, and they take a backseat in their priorities. So let's take a quick look here at the Zillow article on the affordability crisis. So I wanted to point out to this affordability crisis article by Zillow, which states that the United States needs 4.3 million more homes. Essentially, not enough homes are being built, and that there is a gap between families and available homes, which is widening likely, and is likely to continue to grow. So it says that the nation's housing stock grew by roughly 6.3 million housing units from 2015 to 2021, and the number of families living in the United States increased by 7.9 million and 7.1 million. New households were formed during that period. When household formation outpaces growth in the housing stock, the number of available units falls, and competitive pressure builds, pushing housing costs up. So also there were 15.6 million vacant homes in 2021, but only 3.7 of them were available for rent or for sale. Meanwhile, there were roughly 8 million families nationwide, doubling up with non-relatives in a home that did not themselves own or lease. The worst housing unit deficits were in expensive coastal markets like Los Angeles, San Francisco, San Jose, San Diego, and Boston, Boise. So 80% of families that were doubling up with no relatives had a family income of $35,000 or less. The article also states that recent housing affordability challenges have shed some light on the fact that the U.S. has not been able to build enough to keep up with demand and allow families to live in the type of units and arrangements that they would choose for themselves. Not only does the number of missing households without a place of their own to live exceed the number of family available housing units, but this gap has increased over time. And the magnitude of the housing deficit and how quickly builders can fill this gap will go a long way toward determining the path for U.S. housing affordability. Some experts are also saying that the prices of crude oil and energy prices have bottomed down this month, which means that we are going to start seeing again an increase on the energy prices, which also is going to have an effect on the construction costs. And with reduced demand and economic uncertainty, housing prices are experiencing downward pressure, and sellers are finding more and more challenging to achieve their desired prices, leading to a softening of the housing market. We have seen this last year that prices have decreased all across the United States. In particular, the coastal cities have seen the biggest decline. So stagflation often leads to higher inflation, prompting central banks to continue to raise interest rates to control it. And higher interest rates mean more expensive mortgages, not even accounting the rising homeowners insurance that not only California is suffering, but other states like Florida are also going through that. Which is also dampening the demand for homes. We are also seeing the commercial real estate take a hit. Stagflation has had a big impact on the commercial real estate sector. Businesses are facing reduced revenues and higher operating costs, and we have seen a lot of the high-tech companies do massive layoffs all across the board. So these higher operating costs due to higher energy costs and inflation across the board during stagflation is leading to lower demand for office and retail spaces. We're seeing entire buildings basically not have any occupants. This could result in increased vacancy rates, which we're seeing, and a slowdown in the commercial real estate market. As far as the rental market goes, while stagflation might dampen the demand for home ownership, it can also have interesting effects on the rental market. Although it is believed that the demand for rental increases, the truth is that we are even seeing certain markets experience declines on the rental prices slightly. However, the rents for entry-level homes remain strong. Also, the housing development, of course, because of all these increase on prices across the board, especially now, energy prices, we're seeing that during stagflation, investor confidence may wane, making it harder to secure financing for real estate projects. This slowdown in development can further impact the supply of housing units and commercial properties. But we're especially seeing, especially with the climate agenda, that stricter green building requirements are leading to increased housing costs and making it challenging for developers to provide affordable housing options. So in conclusion, stagflation is an economic condition that can have various effects on the real estate market, from decreased demand and weakening housing prices to increased rental demand in certain areas and development slowdown. The real estate sector is not immune to the challenges of stagflation. And as always, I encourage you to stay informed about economic trends and make well-informed decisions regarding your financial situation. So thank you for joining today. If you found this video helpful, don't forget to give it a thumbs up and subscribe to my channel for more insightful content. Until next time, take care and stay tuned for more economic updates. Thank you.